this is Mike Mascia at Cadwalader. Thanks for dialing in to Fund Finance Friday Industry Conversations. This week, both the ICE benchmark administration as well as the regulators put out statements on the LIBOR transition. And frankly, when I read the regulator's statement, it felt like it was written in Fed speak. And even though I thought it was an extension, it never said it was an extension. So I've asked Jeff Nagle, one of our LIBOR transition experts, to join today for a couple minutes to try to put what happened this week in plain English. Jeff, how you doing?
Doing great. Thanks, Mike.
Thanks for joining us, man. Tell us what happened in a way that a fund finance banker can follow.
Sure. So we all came back from our Thanksgiving, long Thanksgiving weekends, sat down, started to work on Monday morning, and around 9 a.m., some pretty big news dropped in the LIBOR transition world. There were coordinated releases, press releases by entities on both sides of the ocean dealing with the timing for LIBOR transition. So on the UK side of the house, there were two announcements. The IBA, the ICE benchmark administrator, who is the administrator of LIBOR, announced its intentions to consult on ending 1 week and 2 month LIBOR, which are very lightly used at the end of 2021. But the big news was ceasing to publish the other tenors of USD LIBOR on June 30th in 2023. So an extension of 18 months beyond what the market was previously anticipating for USD LIBOR. The UK's Financial Conduct Authority, the FCA, announced its intentions to consult on using their powers to prohibit the use of a benchmark, meaning USD LIBOR, by regulated entities, but they don't intend to use that power until the end of 2021, signaling that they are going to be likely telling their regulated entities that LIBOR is out there, but you shouldn't be using it other than in certain circumstances after the end of 2021. Which mirrors the announcement that was made by the regulators on this side of the ocean. So the Fed, the OCC, and the FDIC, the major US banking regulators, put out a statement welcoming the IBA's announcement, but also noting that the use by US regulated entities of USD LIBOR after the end of December of next year would create safety and soundness problems, and that they would, quote, encourage banks to stop using USD LIBOR next year as soon as possible. These are pretty strong statements by the US regulators, basically telling banking institutions that while LIBOR may exist post 2021, we don't want you using it, and you should not be using it other than in certain circumstances.
So Jeff, what does a fund finance banker need to take away from this and do?
So I would think of this, the way I tend to think of it is in three different buckets. One is for new issuance, so new product that you're going out and issuing, or new loans that are being renewed. The takeaway here is still move away from USD LIBOR. If anything, you now have a regulator on the record saying that it would be unsafe and unsound to issue LIBOR after the end of 2021, and they encourage you to move away from USD LIBOR as soon as possible. So there's a very strong regulatory push to be moving away from USD LIBOR to an alternative reference rate. So my advice would be to continue full steam ahead with your plans to cease issuing new USD LIBOR next year and start issuing in other alternative reference rates. A second bucket is remediation. So this is, what do you do with old contracts that are issued in USD LIBOR and may or may not have the best fallback language? This is really what this additional 18 months is going for. So the 18 months provides you a time for a couple of things. One is an additional time period for loans to just naturally roll off. There will be a very significant portion of most banks' loan books that will expire during that time or need to be renewed. And therefore, instead of having to actively remediate these to put into place fallback provisions or utilize fallback provisions, they'll just more naturally be refinanced from LIBOR into, say, SOFR. The second thing with remediation is that by extending out this period, those contracts that do need to be remediated, say you had some longer dated paper in the past that had poor fallback language in it, we've now taken that period and extended it out so that it is not a bank going out and trying to fix all of its legacy book in this 3-month crammed period in 2021. You now have a longer period to do it in a more kind of smooth way. And then the third thing is this allows a little bit more time for New York and federal legislation to be implemented in order to deal with truly tough legacy. The Fed has mentioned on calls that they're still going to be advocating both federal and state legislation for truly tough legacy. So that deals with new issuance, that deals with remediation. The third area that I'd look to is fallbacks. And here we have regulatory guidance saying that banks should be including robust fallback language in any new USD LIBOR issuance. So hopefully people have been doing this for some time, putting robust fallbacks into their paper. It would be, if you have paper that is going beyond the end of June of 2023 at this point, not including a robust fallback is not a great idea, but we have regulators actively encouraging that. So people should continue using robust fallback language in their documents.
So Jeff, what about multi-currency facilities though? Is there a corresponding change in extension with respect to other currencies, or are we going to have a mismatch?
Yeah, unfortunately, we're going to have a mismatch. The other currencies are moving full steam ahead at cessation or non-representativeness by the end of 2021, which is not surprising. In many ways, the UK sterling has been out in front of the USD market in many ways through LIBOR transition. So the impact of this is that for multi-currency facilities, you will likely have some of your currencies transitioning away from LIBOR at the end of 2021, and USD LIBOR transitioning away in the middle of 2023. So there will be a disconnect, and that institutions will need to work through that in both their documentation and their operations around the benchmark rates.
That seems a little less than convenient.
It is. I guess the other alternative would be USD LIBOR ending at the end of 2021. So this provides a little bit of runway. The other thing that's important to point out is that while 2023 is the new drop dead date for USD LIBOR, that doesn't mean that people can't transition early. In standard ARC language, there is the ability for borrowers and lenders to trigger in what's called an early opt-in election, and therefore transition away from USD LIBOR before it's actually gone. So if institutions are ready to start using a replacement rate, say SOFR, at some point in the middle or later end of 2021, you could trigger that early opt-in election around the same time that, say, your sterling or euro LIBOR tranches are going to be impacted due to their cessation, and transition your entire facility over to a new reference rate at an earlier date, say the end of 2021.
Got it. Well, Jeff, thanks a bunch for making time to chat with us today. We'll have you back on the next time there's a big development in LIBOR transition.
Always something new in the LIBOR world, keeping us on our toes. Thanks, Mike.
Thanks for tuning in to Fund Finance Friday Industry Conversations. If you have suggestions for how we can make these sessions more productive for you, please give me a call. Have a great weekend.
The material and information contained in the podcast is for general informational purposes only. Any use of the audio within this podcast without the express consent of Cadwalader is prohibited. Quotes from this podcast may not be used without the express permission of the speaker.